Good morning and welcome. My name is Teresa Campbell, and you have joined the PIM Printing Industries Midwest and PIA Mid-America Financial Executives Council program on benchmarking and performance metrics. Note that all of our attendees are initially placed in mute mode to ensure a quality recording. However, we encourage you to raise your hand by using the reactions on the bottom of your screen, and we'll unmute you to be able to speak, or feel free to type in the Q&A field at the bottom of your screen, and we'll communicate those questions that are appropriate at the time in the slide series. If you have technical difficulties, we ask that you put those in the chat field. If you're new to this group, know that the Financial Executives Council is coordinated by leaders in both the North Central and South Central regions. They guide the programs and content offered 6 times a year, and the focus is around financial reporting and compliance, data management and security, and financial policies and planning. Our council co-chairs are Carl Nathy with Myers Printing, Ken Rain with Daily Printing, Ryan Wagner with Action Mailing and Printing, and Matt Wills and Rick Griesgraft with L.B. Carlson. Ken, let's get started.
All right. Well, I am very happy to introduce our guest speaker today, Dr. Ralph Williams. Dr. Williams worked in the printing industry, serving as a president of 3 different companies, 2 of which he was the majority owner in those. Dr. Ralph consulted with printing firms after that. He's earned a doctorate in business administration from Kennesaw State University, and he's currently an associate professor of management at Middle Tennessee State University. He teaches strategy, entrepreneurial financial management, family business, and management principles. Dr. Williams has published multiple articles on his academic research about family business, small business, leadership, and other topics. Dr. Williams is actively engaged in the printing industry associations throughout the United States, and he is currently conducting industry studies, the printing industry performance and insights, and he is writing association articles and speaking at events like ours. And with that, I'm going to turn it over to Dr. Ralph. And like Teresa said, please get your hand up and let's comment and make this interactive as we go through the process. Dr. Ralph?
Thank you, Ken. Can you see my screen? Can, Carl? Everything good? Okay, again, I'm Ralph Williams. Thank you for that introduction. Ken, we're going to talk today about the insights that we drew from the financial benchmarking report, our study in 2023. This was part of our printing industry performance and insight studies, which we do twice a year. In the spring, we'll do the financial benchmarking. We did our first one in the spring of 2023. We'll do another one in the spring 2024. In October, we do a study where we're seeking the industry outlook and how macroeconomic things are affecting our industry, and also we address a management topic. The topic we're addressing right now is how to brand your firm as a good place to work. And that current survey is out, and if you haven't completed it, I'd appreciate you considering. It's what we're hearing from folks who do complete the survey is that prompts some thinking. I mean, the questions that I worked with my HR colleagues here at Middle Tennessee, HR professors, and the questions we're hearing prompt some thinking about how to promote your company as a good place to work. So moving on with looking at our last spring's study. Okay, this was a study. This is the results of a study we did back in 2016, and then we replicated this study and found the same results. And what we did is we looked at 6 different management practices. Social capital is networking in the community or in the industry. Strategic thinking is strategic planning, goal setting. Entrepreneurial orientation is the culture in your company that you create as far as innovative thinking. Quality focus is related to TQM, that culture where you're focused on quality. And then analyzing financial ratios. That was all of these 6 management practices had good correlations with firm performance. In other words, they were positively related with firm performance. However, analyzing financial ratios had the highest correlation. And again, we found these results again in a study in 2022. Now, what's interesting about this is that although there's that strong relationship, only a small proportion of small business leaders analyze their financials. And I talked with some other folks that are involved today. Ken and Ryan, I think, was involved in this, maybe Carl, but only a small proportion of small business leaders analyze their financials. And this is what we're trying to do. I'm not an accountant. I'm not debits and credits. I'm all about looking and learning from the financials is what we're trying to do. It's interesting that the proportion in research shows the proportion of small business leaders who analyze their financials has not changed, even though the technology in accounting, like Excel and QuickBooks and things like that is evolved. Still, the proportion has not increased of small business leaders who analyze their financials. So this is a competitive advantage you can develop to use this financial analysis for strategic thinking. It was very much for us. I tell this story often. Actually, it's in an article that we printed in several association newsletters. But the first time I did this in the first business, I analyzed these financials, learned how to do it at a seminar, came back. I wrote those numbers on some boards in front of my management team. There was about 6 of us. And I showed them, this is what our numbers are, and this is what the profit leaders' numbers are. And then I sat down, and I said, what should we do? And they came back and they said, we need to do this, this, and this. Then they got up and did it. And this was analyzing the financials. Again, not from an accounting standpoint, but from a strategic standpoint, was a key part of the 3 businesses that I led and the success we enjoyed. So what we want to try to do with this knowledge is help you improve efficiency, do more with less, increase sustainability. Now, sustainability, that word is often tied with environmental things. That's not what I'm talking about here. I'm talking about if you manage your financials better strategically, your business will stand up to threats. It's sustainable. Focus on the right problems. Should you attack cost or should you attack selling or work on selling more? Make your business more attractive to investors if you can improve the financial performance. Improve the owner return. That's your return typically that you take from the business, and then improve the profits and the cash, and that affects what you take home. So moving forward, we're looking at 3 different sections, maybe 4. We'll start with income statements and cost categories, just some overviews of what we found in this last spring. We'll look at some balance sheet ratios. We'll look at some cash management indicators. And then we'll look at some key takeaways and ask some questions about today. So that's the path forward. So here we go. Again, please, any questions anytime. It's not a problem. Stop me anytime with the question, as Teresa mentioned. Okay, so income statements. This is a sample from our report that we produced of the income statements. Now, we have in our report, we have 8 different income statements. And what we do is we try to we try to determine industry segments more than just size. And we need to do a little bit more for size. We need a little more participation to do that. But also, we try to look at different strategic groups or industry segments. When I was a decade or so ago, when I was in this industry, every $6 million printer was very similar. Sheet fed, a little bit of digital, and a lot of bindery and that sort of thing. Now there are all kinds of $5 or $6 million printers out there, printing companies. So we try to determine those groups and provide those financial benchmarks for each one of those groups. So this table 1 over here, it represents all firms. We had 104 firms provide us numbers that we could develop. And out of those firms, we determined there were 35 high performers that we determined. Now, in determining the high performers, we just didn't say, okay, the top 25% or the top 20%. We did a little bit more methodically. What we did is we looked at the EBITDA, and we tried to find a substantial dip in EBITDA as far as the percentage of EBITDA, so that we could classify that as a group. So 35 of the 104 firms, we found them as high performers. In our report, there's high performers in 4 of our 8 tables. If we didn't have enough participants, we didn't want to say anything that wasn't valid. So again, there's 4 of the 8 tables we have high performers. We hope to have more participation next year, next spring, when we do this. So that explains a little bit about our study. Now I've broken so I can make them a little bigger. I broke the income statements up into parts here. So we're looking at EBITDA, and you're probably familiar with that, but EBITDA, earnings before interest, taxes, depreciation, amortization, is an excellent benchmarking tool. It's excellent because firms in different states have different taxes. Different firms may have different levels of debt depending on their bias there or how mature they are. Different firms may take different approaches to depreciation. So EBITDA is a good way to compare companies and kind of pulling away some of the other stuff that can change. So it's an excellent benchmarking tool. Here was that was astounding. You see that we had in all firms EBITDA of about 11.4%. But look over here, we had high performers, 35 of our 104 firms. A third of those firms had EBITDA up around 19%. That's a strong number. I think my financial colleagues here would agree with that. 66.75% difference between the all performs and the high performers. So, that's a 67% high EBITDA. That is a strong difference. There are firms in our industry that are rocking. That was surprising. Another thing that was one takeaway. There are firms in our industry that are rocking it. And as we looked at this, little improvements in all these cash categories, they add up to a substantial number. Anybody want to share any other thoughts about this related to the amount that this shows that we do have rocking firms in our industry, or how there is how they're doing this? Any thoughts?
Dr. Ralph, I would just comment that oftentimes it is the EBITDA that is being used to determine value when facilities are being bought and sold versus other types of measurements with assets or so forth.
That is yes, and that is a very important aspect. Yes, that makes EBITDA even more important. Good point. Any other
Yeah,
thoughts or
it is
comments?
definitely a common measuring stick in companies, and I think you get interest into this a little bit farther along in reviewing this for your own financials and seeing what these numbers and how they compare. It's helpful, as you mentioned earlier, as you start breaking it down by size of company and by type of printer, where you can really then compare it to yourself and get value out of how you compare it to others in the industry. And are you a high performer or in the middle of the pack, and where you match up and really start digging into why that is.
Well said, Carl. And that's what we did. What do we need to do to become a high performer in our industry? And it made the difference. It helped us in our strategic thinking. Yes, Teresa.
So there's a question from the group, and it's, did you analyze the DSOs of the high performers compared to the rest?
DSO. Carl, what's a DSO?
That'd be daily sales outstanding. Maybe they can clarify the question.
I'm not really familiar with that. We do have some cash management things that may relate to that. So I'm being candid. I'm not familiar with daily sales outstanding. Okay. Anybody want to comment or help me with that?
Yeah, anybody from the committee ever use that as a form of measurement?
Yeah,
I think they're looking at how quick you collect your cash receipts.
Okay.
I think that's days outstanding for the accounts receivable.
Yes, we will address that. Days in accounts receivable, we will address that here in a few slides. Okay, can I move forward?
Excellent.
Yep.
Okay. So again, looking at income statements, we're looking at high performers versus all firms. Paper, high performers spend a small percentage of total revenue on paper. And you look at this, the difference between 23.08 and 21.38, that's a 7.37 difference. So, and you look at the different graphs or the different groups we had, that range from, it was 7.37 difference, but in some of the groups we had, that number was as big as almost 16%. So this question, why do you think high performers spend less on paper? Anybody want to throw any thoughts out there?
Buying power. They have influence.
Yes, that is a point. Buying power.
Efficiency of, and maybe it's equipment waste.
Yes.
How much they're wasting when they're running their products.
And we don't have a right answer, but this might prompt that strategic thinking. How can we do better with that? Other thoughts?
There's a comment that digital stock is much cheaper. Paper for digital presses is cheaper.
Okay.
Also, being able to add more value added, so fulfillment services, bindery, stuff that you do that doesn't include the paper that bolsters your sales figures.
That what y'all are saying, I'm sorry, you'll hear the word y'all from me a lot, but the Southern in me, you're complimenting what I'm going to say, the points I've got. They may have higher prices to customers. They're in a position from a market or a value standpoint, they charge more, and that increases the value add. Ken, that's a good point. Related also, I think Ken or Carl said this, they provide more complementary services that are not involved in paper, like fulfillment, like web to print, like design or marketing services and that sort of thing. And we'll talk about that a little bit later. Again, y'all are complimenting very well. More efficient, less waste. That's a big deal. Now this came up. Somebody said in one of these webinars we did, or one of these presentations, that more successful printing companies can buy more inventory, which will reduce the prices. However, when we get to cash management numbers, they really don't support that. So I think you've shared. Anybody have other thoughts? Okay, Teresa, moving on.
Mm-hmm.
Okay, the next thing we're going to look at is total factory cost. So 3 of the industry segments we looked at, high performers spent less on factory payroll and benefits and total factory cost. And there they are, about a 6% dip for all firms versus high performers. So why do you think, what are some thoughts? Why do you think higher performers spent less in factory cost?
I think some of them are just more efficient in their ability to produce, whether it be newer equipment or rock solid processes.
Mm-hmm.
I know that in our business, when we have some issues and some spoilage, it's because we're not following the process. And if you have good communicated processes that are uniform over all shifts, we find that it goes pretty smooth, and you see a lot of gain on time, or throughput. That really adds up fast.
Good point, Ken. Other thoughts?
I would say facility costs, depending on if they own their building or lease their building. Potentially also utilization of equipment. Are they able to, maximize the value of their equipment and, get direct labor dollars on their equipment rather than have a lot of indirect labor costs?
Yes, and again, I'm really big on benchmarking, and we're not saying this is the reason why they're spending less on factory cost, but if you look at your segment or all firms and you're at a higher area, you're spending more on factory costs than others, you might back up and say, why? What can we do to improve? This is what the benchmarking, the strategic thinking that comes from this analysis. Economies of scale. Y'all familiar with that? We were very big on this in our companies. In the last company, we ran 6 days a week, 24 hours a day. We wanted to get as much out of our investment in fixed cost in the factory as we could. We had 4 10-hour days, but we told our employees, our goal is for you to work 5 10-hour days. We budgeted so that we were covering our fixed cost in regular time, but then in 40 hours, but then that was a very conservative budget, and we would work overtime after we covered that fixed cost. And that was economies of scale, helped us a lot. Culture, TQM, total quality management, related to some of the things I think Ken said. It's are we efficient? Are we lean? That is really, and studying this over the years, that's a cultural issue. Our culture is very efficient in our production. And so, are you doing that? Increasing revenue without increasing factory cost. Don't assume we need to add this or add that. Increase the revenue without increasing factory cost. Any other thoughts? Again, benchmarking to drive you to work on this is very important. Any other thoughts?
I don't see any comments, Dr. Ralph. I would just add, that before major decisions are made, like adding a second shift, are they looking at how much capacity they have with their current staff? Are they looking at overtime? Are they looking at how much they outsource? And bringing some of that in-house are often items that drive strategic decisions.
I bet, and we've got some data we want to analyze, but I bet there's a connection between your analyzing your financials and budgeting. And budgeting is so important. This came up last night in the strategy class I teach from 6 to 9. And I get the greatest group of students at 6 to 9 on Tuesday nights. I've taught that for semesters. This student that I've had in entrepreneurial financial management, his family business, they make pallets. And he came to me and he said, Dr. Ralph, we are considering stepping away from a major customer because they're pushing our prices down. Their demands are great, and we may just not work on meeting them. And I said, Hignan, you or Spencer, you might budget and see if you lose that revenue, what you'll need to do to accommodate that. And he nodded. And using that as a strategic plan, what will we have to do? How will that affect us? So it's important. Yes, budgeting is important. And I think it's tied to financial analysis. Actually, I think everybody might experience this. The last week of the year, things quieted down at our company. And I would use that week to really work on budgeting, hunker down and do it. Okay, let's move forward. Let's talk about depreciation. This is interesting. It's consistently high performers incurred more depreciation than all firms. It was interesting. Why do high performers incur more depreciation costs? Any thoughts?
I think the high performers are constantly upgrading their equipment, the newest and the best. And front end of that piece of equipment, higher depreciation.
Okay. Other thoughts? All right, I want to point out a flaw in our study, and we need to address this next year. One is, are you renting? Are you owning the building? If you're renting the building, you may not have as much depreciation as if the firm owns the building. And so many times the owners of the company own the building and they rent it. So we need to look at that a little deeper. We tried to last year. We didn't apply questions good enough, but we'll do better with it next year. That could affect this. I don't know. The higher performers may own their buildings. I don't know. And back to Ken's point, investing in new equipment, technology and automation, and in reading material in the industry, I'm seeing that push toward automation. It helps fill the employment gap. One of the studies we're talking about doing, one of the things we're talking about employing as a study, working with the great professors, the colleagues that I have, because I'm not an operations person, but I'm operations professor, but I've got great operations supply chains professors that work with me, is what's the best ways to address and plan and manage that automation. So we're talking about studying that. When you consider a new equipment, you need to develop, again, budget, a pro forma income statement, and consider the financial effects. And I say to do this more than with a passion. I'm being very candid here. In our first business, I made some equipment decisions that were really based on passion. I wanted us to get into web printing, and we did, and it worked. But I didn't do the analysis that if I were now, I would do the analysis deeper and do a budget. Also is look at the return on investment, and we'll talk about that more later. And again, our report that we produced from this, it discusses on how to do all this. So, all right, let's talk a little bit more about the income statements. This is total administrative cost. Consistently in the different groups, high performers incurred less administrative cost. When you look over here, it's almost a 22% dip between the high performers and all firms. 22% dip less for all firms. Teresa, what are you thinking?
We have a member who asks about bonus depreciation. What are your thoughts there?
Bonus depreciation. Ken, help me with that, or Carl?
I think that's typically more applied for tax purposes as opposed to kind of more of your financial P&L. You can accelerate some depreciation for paying taxes. So it reduces your income.
And that pushes the on. Now that's a good point, because that may be why they have the higher depreciation, the higher performers. Back to that. That's a good point. Thank you. Yeah, that's a good point. And also the prevalence of EBITDA, yeah, is important. Answer that. Okay, so maybe they're doing more with less administrative resources. Now, another question: why do high performers spend less on admin cost? Thoughts? Okay. Maybe they have staff members taking on multiple roles. Maybe they're increasing revenue without increasing their admin staff. Maybe they're benefiting from technology to replace some of the manual tasks. Maybe they're outsourcing some things. I have a relative who was director of marketing sales at a printing company, and they outsourced some of their administrative things internationally. It was amazing how cheap they were able to get that done. They may have a higher quality staff. Any other thoughts?
Well, you already listed it, but we have somebody that said leveraging technology to streamline processes. So obviously, if you have a press that runs twice as fast, you can get twice as much done.
Yes, and leveraging technology. I love the word leverage. I love, stick the bar under the rock and pick it up. I like that. That's good. Any other thoughts?
We're trying to do the same. The less touches, the better. When you think about it, just for administrative, I look at it as like doing payables. Combining. Getting either a check or an ACH, combining those payments. So you got one less, payment to process. Invoices, trying to get those processed in an efficient fashion, or maybe you get one group invoice, just the less touches, the better.
Great points, Ken. Yes. Yeah, group invoices. That's good. All right, now I'm going to frame this question a little differently now. Why might lower performers spend more on admin?
Going back to what less. This is more touches. You have one person creating the invoice, and then you have two people proofing it, and then one person else is sending it. You just add different layers, and that's the way we always did it. Instead of looking for a new way to say, how can we do this more efficient?
That Ken, that relates to a point I make with this. A lot of times we did, and I think it's guilty. We don't take the same efficiency look at our administrative work as we do our factory work. That's a different attitude. Also, there may be relationships. That person has worked with us for 20 years, and and we're not pushing them. It's just the relationship, maybe family relationships, all kinds of things like that. But again, not looking at the admin in the same way we do as the factory from a production standpoint.
Well, that makes sense. And I saw the chat pop up, and I'm going to let Teresa comment because that was spot on.
The comment about doing things the way they always have and not embracing technology.
Yes.
Or having staff afraid to change and leverage existing technology.
Yes. Yeah, you have inertia. That's the way we do it in the office. We're very automated. We're very automated, or looking for improvement and that sort of thing in the factory, but we have inertia in the office. That's great point. Great point. Okay, now let's talk about sales and marketing. And again, this is all about benchmarking. We're not saying, there's not the answers in this, but it prompts the thinking. If you're if you look at the ratio, if you look at the numbers we have and you're not doing well from an administrative, stop back and think about it. Use it as strategic thinking. Okay, now total sales and marketing. Now this was interesting. Higher performers spend about 2.5% more in total sales and marketing costs. 3 out of 4 groups that we had spent more in sales and marketing. Now this might prompt you to invest more, but look at it strategically. I would say, look at if we add this or do this and it generates this much revenue, what does it do from a budget or standpoint? If we do this and it doesn't add the revenue, what will it affect? So I don't think this should prompt you just to do it, to think about it, any thoughts from the group here?
I'd be curious to know, the split between sales and marketing. If the high performers are spending more in the marketing aspect of it, or if it's on the sales side, they maybe have higher sales reps or more sales reps or higher dollar sales reps, more effective sales reps. So I'd be curious to know which of the buckets is actually driving the higher. Maybe it's both.
That is a great point, Carl, and that's something we wrestle with. And I'm open to input here, because we wanted our survey to be simple enough that you could just put broad numbers in, but there's also the need for detail. So we're balancing that, and we'll wrestle with that some more next year. We have it kind of grouped. We'll wrestle with it a little bit more. In fact, you may be looking at my survey before I do it, Carl. So moving on. All right. This is providing related services, and this kind of relates to that paper statement. We talked about higher performers and less paper. What we do is we found we're talking about non-print services that complement and expand firms' value that they provide customers. And so we found 23 firms that provide significant other services out of 96 for that group. And their EBITDA was about 24%, 23.5% higher. And I'll name some related services. I've got a friend, he runs a printing company here in Murfreesboro, and they do marketing services for other small businesses, doing the website managements and that sort of thing. You could do fulfillment, photography, and the list goes on of things that you might do as related services. Some are getting in. There's a company in Chattanooga that's getting big in apparel and screen printing and that sort of thing. So, and this is consistent with other findings from our studies, where we find that companies that have these complementary services, they do a little better. But it's not an easy decision. It's a strategic decision. You can't just say, oh, we're going to just do this. You got to say, how can I provide more value to what we provide our customers? It's not an easy decision. You got to consult with your customers and build that budget and see how it works. So one of the co-authors in this study, Luke Herron from California, he said he's seen many companies who didn't decide the right complementary service or didn't execute it right. So it's very important to think about this strategically. Any other thoughts?
I think your point there is right about finding the right complementary services. Because if you get just too many capabilities and services, you just spread yourself too thin and you're not good at any of them, as opposed to really focusing on ones that are adding value to your customer base.
Well said, Carl. Well said.
I think you also have to know your customers and find out what their goals are for some of their projects, and kind of pick up on well, they need this fulfillment service, or they do a lot of mailings. They need data tracking.
Mm.
That's a big one right now is, if you own the data, that makes you more powerful knowing your customer base. So, getting database services. So there's more out there, but you got to know what your customer is looking for and give them the ability to kind of shop with you and say, yeah, they're doing this and they're going to do that for me now too.
I love that. Well said, Ken. I think going to those customers and saying, what do you need? How can we help you? And an open-ended question, how can we help you? That's very important. Now, I read an article recently that talked, the 80-20 rule. 80% of our business comes from 20% of our customers, and 20% of our business comes from 80% of our customers. I don't know if you've heard the phrase before, but this article said not only go to the top 20%, go to the lower end and look for ideas, innovation, open-minded. What can we do to serve you? Moving on. Okay, you want to use the financial statement benchmarks to assess your firm's performance. You want to use it to open your eyes to a performance path. Again, this is strategic. It's not accounting. I respect some of the accounting folks I worked with, especially in the last business, were just great. She just walked right into this strategic thinking that we were doing, and we worked so well together. Where should we apply less resources or more resources? This is more than budgeting. This is strategic planning and thinking from your financials. Ken, Carl, Teresa, y'all agree?
Absolutely.
I agree strongly as well.
Yes.
Yeah, it's using the tool. You think about. I know that Teresa's a big Kansas City Chiefs fan. And so don't you know, they look at their benchmarks and decide what they need to change. They do that every week. You can bet on that. In the same way, printing company leaders, you look at your numbers and see what you need to change.
I look at it from the strategic planning point of view. We've done that in the past, but when you get away from it, and we have, then you kind of fall back into what you were doing, and instead of forging ahead and trying to get new ideas and new paths and new directions. So that I just put it on my list of things we got to revisit.
You're prompting great thinking, and my goodie bag's not real deep, so you're helping a lot, Ken. It helps you when you do this. And like I said, we did it. We looked at them every month and looked at them every quarter, but really dug down it in December. It helps you avoid hubris. It helps you avoid hubris that we can't do wrong, and it helps you see and plan and that sort of thing. I consulted for a company. They were the most successful company in their region by far, but they had not done anything like this in about 10 years, and it snuck up on them. It snuck up on them bad. They were having trouble paying their employees, and they were the best printing company in that region. Okay, let's go to balance sheet ratios. All right, so balance sheet ratios, and again, this is all explained in our table. It tells you how to calculate these ratios. The first thing we're going to look at is current and quick ratios. Current ratio, we'll talk mainly about that, is your current assets divided by your current liabilities, and it reflects your ability to pay your bills. How liquid are you? High performers were better. If you look over here in the current ratios, $3.3 current assets for every dollar in current liabilities. Over here, almost $3.6. This was astounding to us. This was astounding to us. in my analysis, I've always looked at a current ratio of 2.0 as solid. An accounting, Rodney Robinson, who worked with us on this, he's a printing accounting person, and he says 1.75 is a great current, and we're getting numbers 3 plus. I mean, so this is healthy. You're prepared for challenges. This is the question, why were those so strong? Why were these current ratios so strong in April 2023?
And so there is a comment or question here. Are these current and quick ratios strong due to PPP and ERC in the last few years?
That was the answer to the question I just asked. That's what we think. And we're very interested. In fact, in the current study that we have out there, this is the last week of that study, we ask about your cash reserves, because we want to see, is it backing away from these high numbers? So that's what we're looking at. All right, moving on. All right, here's another set of ratios we're going to look at. This is total debt to assets. Total debt to total assets. And we looked at total debt to total assets, and all firms around 46%, high performers down around 42%, 47 to 42%. Now, when we see total debt, we use total liabilities in this ratio. Some people use just long-term debt, so it's all liabilities. It's a little higher for the higher performers, a little higher than high performers for all firms. It kind of reinforces the current ratio numbers that we had, for them to be a little better there. Long-term debt is very close. Using this, you might assess how much debt you're using, around 45% of total debt to ratios. Now, I can make an argument for the leveraging of debt to assets to say use more debt. I can, for to reduce risk, I can say use less debt. I can't give you the perfect answer. That's up to you, but this is a benchmark you compare to. Any comments there? Any other points there, Ken, Carl, Teresa?
We normally don't look at that, too often for the long-term debt. We're looking at just the quick ratios, current ratios, kind of more of the liquidity than the, those long-term ones.
Some of these ratios, and yes, I can see not spending the time looking at them, but an example I use in my financial management class is we look at a current ratio from a business, and they've got like a 3.0 current ratio, but it drifts down over the quarters. It's still good, like at 2.2. However, seeing that change is a good thing to see, before it bites you. By the way, this class, I love it. I love to teach because I've got a passion for this financial benchmarking. These students typically have no accounting classes, no economics. They're entrepreneurship minors who come in, or entrepreneurship majors. And we start talking about these numbers, and they look like deers in headlights at the beginning of the class. At the end of the class, and we're at that point, I teach it again at 2:00 today. I'll say, can you do this? And they'll say, I got this, Dr. Ralph. I mean, they get it. It's just great. It's just great. Okay, another ratio. We're going to look at return to total assets. All right. Look at the difference. Return to total assets for all firms around 13%. Return to total assets for high performers about 34.5%, 162% higher. I mean, that's huge. That is huge. Now, my benchmark, if you think about a mutual fund, the average mutual fund, as I understand, a well-diversified mutual fund where there's less risk draws in 8 to 10% annually. So if you're going to invest in assets for a business and there's some risk involved, you'll want more than that. My benchmark is around 17% is a good number. If your return on assets is less than 17%, you might look for reasons to increase your net income or divest some underused assets. If you're considering buying more assets, whatever, building, trucks, equipment, presses, if you're considering that, project your net income, worst and best case, and then project your ROA to see what happens to that return on asset. So I think that's an interesting. Any thoughts there? I see it as a great tool. Okay, we'll move on to the next section, which is cash management. So in our, again, I don't know that all small business owners how to calculate this. This is in our tables, in our report, okay? Cash is important. Cream, cash rules everything around me. Cash is the blood of the business. It's important. Cash is king. You've heard that. Profitable growing companies can run out of cash. This was an issue, especially in my second and third business. We were growing at 25% a year for multiple years, but that 25% of growth soaked up more cash and accounts receivable and inventory and all kinds of things. And so we really had to monitor our cash and use these ratios. And the three ratios, days in inventory, days in accounts receivable, and days in accounts payable were the three that I think are very important to look at. Okay. Days in inventory, how long does inventory sit on our shelves? I think that's an important thing to think about. When you look at inventory, look at it as cash on the shelf. I consulted for a company. They were really struggling. They were losing money, but they were in a cash crisis. And I went into their warehouse, and there were skids and skids of paper everywhere as a label company, and they had a huge amount of paper, even though there was a paper company 10 minutes away. And I said, we're not buying any more paper. And that helped us because that cash came back into the checking account. When you see inventory on shelf, see it as cash. High performers had about an 85.8 days in inventory. All firms a little bit over 100 days. I think it's important, given the paper situation, and it's improved dramatically since last year. We're seeing that. I don't know that it may change and go back. I'm worried about that. But I think it's important to measure. You remember earlier when we talked about cash, the higher performers spending less on cash, we wondered if they had so much inventory or bought so much that they were able to pay less for paper. But this indicates not. They've got less inventory, if you will. This is, and Teresa, I need to write this paper. We've published it as an academic paper, but the importance of applying supply chain, not from an emotional reactionary way, but from a rational approach. And I need to write that's my next practitioner paper that I want to try to put out for y'all. The other issue, and I think, and then Ken and Carl may relate to this, I think the accounting in our industry has to address. 15 years ago, when I was running a printing company, paper was a commodity. We brought it in, we used it, we shipped it. We didn't have inventory. We didn't measure the inventory. I think it's important to measure and adjust now. So anyway, we see days in inventory. That this is a little bit, when you look at it in a big picture, that's still close to 3 months. You think about, do we need 3 months of, if the paper situation is better, do we need 3 months of inventory of that cash tied up? Any comments?
Yeah, I think that inventory one's been one that's been tricky over the last year or two with the supply chain issues. A lot of people have had to get paper whenever they can get it, so they kind of stocked up for a bit. Like you said, that is hopefully easing now and getting back to more normal levels, but it's certainly something that can get out of hand and you want to stay on top of. Otherwise, you've got a whole warehouse full of unusable paper.
Yeah, I'm going to tail in on that, Carl, because we've seen a lot of that, and we store some inventory for customers as well, and they're trying to burn through it. But now the pricing has eased with the supply chain getting better, and so now they're sitting on paper that's probably on their books higher than you can get it now.
Wow.
And so, yeah, we were trying to buy just as we go, and you've got to inventory to a degree when there's shortages, but we've been pretty lucky that we aren't burned by having some outdated stock like Carl was referencing.
From our current survey and looking preliminary at the data that I'm getting in, it looks like the situation has improved dramatically. By the way, my supply chain professors, when I drugged them into this paper thing last year, they just wrapped their arms around it because it was so interesting to see these changes in our industry and what's happening. The concern, and I don't want to scare anybody, the concern is, will we have a bullwhip effect? Will we, because we're eating up supply that we had in our printing companies, paper mills are producing less. When printing companies start buying a lot more, will it cause that bullwhip effect, that problem with supply again? I don't know. There are people who argue maybe. There are people who say no. So I don't know. But I think it's important to manage this days in inventory and strategically think and prepare for what might come again. Carl, what are you thinking?
Yeah, I don't have any insight on that, but it's certainly a number to keep an eye on.
Yes.
For sure.
Yes. Okay. The next one we'll look at is days and accounts receivable. Now, is this the same thing as daily sales outstanding that was mentioned early?
I think it's getting to the same point, yeah.
Okay. All right. I hadn't heard it phrased that way. That's interesting. So how long do our customers take to pay the invoices we send? Days and accounts receivable. You can see that days in inventory. I put that on the wrong thing. I am so sorry. You see, I've got it on the wrong thing. It needs to come down. My apologies. Do you see what you see? This is what applies. 47.43 days for all firms, 38.87 for high performers. So we were pushed from a cash standpoint, even though we were a good performer and growing. So we really had to monitor this. We looked at our accounts receivable every Wednesday. We did our cash budgeting every Friday. We paid our general manager, our admin manager. We paid her a bonus if our accounts receivable, days of accounts receivable, were under 42 days. She received a bonus, and so she called. So we had a method for addressing that accounts receivable. There was another thing. I was consulting for a company. They were having cash problems. They would finish a job and ship it. It would take the accounting team 2 or 3 days to produce the cost and the report. That would go to the salesperson. The salesperson would figure out the invoice, and then it would take a week or two to invoice. In our last company, we invoiced the day after the job was shipped. And that really did help our cash. It didn't change the days in accounts receivable because it doesn't count till it's accounts receivable, but it really sped it up. Those were kind of approaches. We wanted to invoice the day after it was shipped. Now, here's a question. Should salespeople or admin folks contact customers about accounts receivable? Thoughts?
We start with admin, and then if they can't get a response, move it to the salesperson.
That's an interesting approach.
I would say that's the majority of how we handle ours too. There are some sales rep customer relationships where they want to handle all the communication. So they want all that stuff to run through them. But as a general rule, we keep the salesperson out of it unless they need to get involved.
Yep. Same with us.
Yeah.
We do the same.
Ryan, are you coming in?
Yeah, we do as well. The only thing that some of our sales folks say, and I think Carl mentioned it too, is that they see it as an opportunity to reach out to their clients, even if it's contacting about that. They can also speak to upcoming, just another inquiry, another touch with the customer.
You know, I presented this in Louisville at a luncheon, and it was interesting. We had, to say it's conflict, but we had some leaders that focused on the salesperson doing that, and some focused on the administrative folks doing that. I'm not going to say either one's best. We did the admin, but come up with a plan. What is our plan?
So Dr. Ralph, there's a question here from the group. Have you done any analysis on terms to now philosophy for AR and the impact to the bottom line profitability? So due upon receipt versus 30, 60-day terms.
Yeah, is that, no, we have not. You're talking about a 2% discount if it's paid in 10 days, that sort of thing?
Potentially, or even due upon receipt versus due in 30 days.
I have not. I have not. We did not apply that. The invoice was due when they sent. Now, early on, we tried that. I don't remember what we'll give you a 2% discount if you pay in 10 days. The problem we had was people would take a 2% discount and pay it in 40 days. So we stopped doing that. We stopped doing that.
Joan brings up a good comment here. If you were to give a 2% discount, she's asking, are folks charging a fee for payment with a credit card? So they can pay it quickly in 10 days, but if they pay with a credit card and you're paying a 3% fee on it, you're really giving away 5%. And then some aren't charging a fee.
How do you manage that? That's some things we may study. That's interesting. Good points.
So another member says reviewing the existing credit policy in regards to terms and adopting a new policy will impact profitability significantly for your organization.
Yes. Okay. I don't have any answers, but those are good study questions.
There's another comment, which this is a great one, accepting credit card payment for faster payment and allowing customers additional days on the AP side paid on statement cycle. Sometimes when they pay it quicker, even though we pay a credit card fee, it helps our cash flow, and then we don't chase that money or spend hours trying to collect it if we allow them to pay with the credit card sooner or potentially give them a discount.
That is a very interesting approach. That's a very interesting question, something we might look at. And it could be different for smaller digital printers or digital printers versus label printers or that sort of thing.
Right.
Yeah. Thank you.
Great point. Another comment from Paul. Dr. Ralph, I have a calculator that does the calculations.
Very good.
Tailing in on that credit card stuff, as we get more of an online presence, that's pretty much the only way to really, to charge a customer. Don't give them terms when they're ordering an online product, and that does speed up the cash flow. We were approached by a company that told us they were going to save us all their credit card fees. Well, the way they couched it after we sat and talked is that they were going to just charge the customer 3% and just pass on the fee to them instead of us paying it. So it's out there. It's just, how do you do it? What's more valuable, that 3% or getting the cash right away?
You've opened the door to an interesting study. Thank you.
Good.
Moving on.
We have one comment that says they plan to add the credit card fee, but undetermined the amount at this point.
Wow.
And so many have gone to credit card. I think Ken's comment about online is crucial, particularly if you don't know the customer and you're giving them terms, and you might not be able to collect because you don't know that customer with an online purchase. It makes sense for a required credit card purchase, so you know you're going to get paid.
All kinds of different approaches. Very valid. I'll talk to some of my finance professors about this and look at some different things, look at some research and see what we can come up with. Good points. Okay, now let's look at accounts payable. This is how long it takes us to pay our suppliers, paying our suppliers invoices. You see, oh, I got that one right. All firms about 71 days, high performers about 61 days, 14% less, have a shorter. Now, there is a bit of a conflict of interest here, that the longer it takes you to pay, the better it is for you, the worse it is for your suppliers. The shorter time you pay quicker, it's worse for you and worse for your suppliers. So it's something to really think about. Higher accounts payable increases the cash in our bank, but higher accounts payable is not taking care of your suppliers that you want to have great relationships with it. So that's the conflict of interest. You have to make rational decisions about how soon you'll pay bills. And I would say do it from a big view and a supplier view. Come up with your plan on how you do that. One thing that we really benefited from, again, in two of our businesses, we were cash strapped because we were growing fast. If we had gotten a great big printing job and needed a truckload of paper, I remember going and talking to that supplier and say, we need to make this order. However, it will take us almost a month to finish it and get it bound and shipped. We won't get paid for 60 days. We won't be able to pay you until this. And to do that up front rather than to do that in hindsight was very important. Now, it's important, I think, to have a plan. Again, what's our big view as far as payables, and then how do we do individual suppliers? Any comments there?
I would say, I mean, go ahead, Ryan.
I was just going to say, we've had some success with some of our longstanding customers that we can bill them up front for paper and then bill them later for services rendered, which allows us to take care of our suppliers a little better. It doesn't work with everybody, but those that we have a good relationship with, we can discuss that.
That's an interesting point.
Yeah, I would just add in the leverage that you have with your suppliers, right? How big of a customer are you to them? How important are you to them, where you can extend terms a little bit more with them or not? But and in your example, Ralph, what you're talking about with having conversations up front, if you know there's going to be delays in timing, it's so much better to get in front of it and then explain, here's what we can do, rather than just not pay it and then have them ask and slow pay stuff. So much better to get out in front of it.
One problem we had with that, though, is if they accommodated us, they expected to get all our business, and we had to manage that.
Yep.
Okay, so I think these items, days in inventory, days in accounts receivable, days of accounts payable, are important to calculate and look at. It will help you. Consider looking at them every month. Okay, moving on to the next section. Here's some key takeaways. High performers spend less on total materials and outside services. When that happens, there's more money going to the bottom line, more money going to cover the fixed cost. High performers spent less on factory cost. Maybe they're more efficient. Maybe they have economies of scale. They incur less administrative cost. They spent more on marketing and sales. They provided more, providing related services enhances performance if it's done right. It looks like higher performers are managing cash better. And it looks like there are performers in our industry that rock. When you look at the EBITDA and at ROA, my goodness, you want to strategically become one of those rockers. Now, here's some questions that I want to throw out. I'll just throw out the whole stack. Is inflation still an issue? And we're looking at that in our survey. Is demand for print growing, declining, or steady, holding steady? The ability to purchase paper, the cash reserves, are they holding stand? What's today look like? Anybody want to add any comments related to that?
I'm going to jump in here. This might be a great time for you to tell them about the survey you got going that's open till the end of the week. Because I completed it earlier, and yeah, all of these are issues to our business. Inflation's a huge one, and it's really big with our employee base. We just went through and we had our pay increases, and I just am concerned that wasn't enough, that these people are living, check to check. And the inflation is really eating at that. But to go back to that is, I don't know, and if Ben can jump in on this, if this was sent out to our group in the printing industry Midwest, for those people that are part of the group, to complete this survey, because it is important to get these things out there so that we can discuss them and use them as tools in our business.
Thank you.
Yes, it has. It has been sent out to Printing Industry Midwest members.
Thanks, Ben.
And Mid-America.
Oh, even better. So, for those on the call here, I strongly encourage, it doesn't take more than 10, 15 minutes, and it makes you think about what you're doing in your business.
Thank you, Ken. Thank you. That's what we want. Now, if you do open it to take that survey, it's best to do it on a computer. It goes much faster than on a phone. So any other comment, any comments? Thank you, Ken. Any comments related to these, just over broad questions about what's going on out there?
I would say that we're just struggling to find a baseline a little bit, because since COVID, and then you have all the money that hit the market in 22, it's going all the way back sometimes to 2019 to find your baseline. And then digging into these numbers, it's hard to tell sometimes, where to start for the following year or even the following quarter.
That's one thing we're looking at in the study that Kim mentioned. The survey's out there now. We're looking at 2020 revenue, 22 revenue, and then projected 23. And then we'll look at the changes in the industry and hopefully in some segments, and then factor in manufacturing inflation to see how that factors in. Now, all that said, it's a good thing to say is when you put that data in that survey, I am the only one who sees that data. I am the only one. It's completely confidential. None of the association leaders don't see it. My research colleagues here don't see it. I'm the only one that sees it. It's only on my computer, so it's safe.
Now, for those of you who haven't taken this, there is no financial data that you're sharing. It's all opinions. It's all how your business is doing without putting dollars to it. So it's pretty nondescript, where you're going to incriminate what you do.
Thank you, Ken. I'm going to move on. A lot of detail in our report. Look at the report. Benchmarking is so important to look, compare, and do strategic thinking. I welcome any suggestions that we can do to help the report. With more participation, we can provide more actionable knowledge, and it's growing, and that's good. So more participation, more actionable knowledge. Any thoughts? There's my email address. I welcome any email from anybody, and I'll answer it. I think I'm done.
Awesome. Well, thank you. Are there any questions out there from the group about things, like benchmarking and certain ratios. I know in the past we used to use the previous ratio study to kind of benchmark what we did to look at our business and if we were competing in the whole industry and where we could improve. And we still use those, but those numbers are outdated. So if we can get some more current data, I think that'd be helpful to all of us in the industry.
That's the goal in what we're doing, Ken.
Well, thank you, Dr. Ralph. I don't see any questions. Now is the time to type those either in the chat or the Q&A so that Dr. Ralph can answer them or have a discussion about it.
Or Ken or Teresa or Carl or Ryan.
While we're waiting on that, I would mention to the group that the wage and benefit survey is complete and we are working on the reports as we speak. So those should be published soon. And of course, those should be used in budgeting and planning for labor cost in 2024. I don't see any comments.
Any suggestions related? Any suggestions from the group as to what we're working on here? Sorry, we want to bring you value. We want to bring association members value. I've been a member of association for 40 plus years. I'm committed to the associations.
Certainly, inflation is a tough one to tackle on two sides. One, paying and keeping up with it, and two, collecting. Are you charging enough for your product with the amount of inflation that's happening? And are your customers able to pay that and keep those customers? So it's kind of twofold.
I would just say from a survey standpoint, like Ken was saying, it's been a while since we've had some ratios available for us to compare to. So it's good to have some more recent data again to look at. And like you said, the more data you get, the more valuable it is to us. You can slice and dice it in more ways, geographically and size and all that kind of stuff, to get more as close as possible to mirror what your own company is. And then it's just good data. It's a measuring stick, right? And the more you measure yourself,
it's a strategic planning tool.
Yeah.
Strategic planning tool. Ben, thank you for managing this from a technical standpoint.
Yes, thank you. Dr. Ralph, will you add or potentially add questions about inflation and how much our members are increasing their rates to cover costs?
That's in our current survey.
Excellent.
And we'll have benchmarks to compare to last year with it. So, yes. And again, I get these colleagues that work with me. I've got a great economics colleague that works with me on this.
Well, this has been terrific. Excellent information. I encourage all of the members on the call to reach out to Dr. Ralph or to your association leaders if you have questions or comments. Really, all of that just makes the data even better. Maybe there's a question we should be adding or something that should be asked.
Ian, thank you for contributing. Carl, the same. Thank you for leading us, Teresa.
Thank you. And thank you to the committee. We appreciate you planning these. Have a great afternoon, everyone.
Cool. Thank you, everybody.
Bye.
Bye-bye.
Bye.